Well, hello everyone. In this particular recording, I am actually going to give you a few pointers for the second exam. So, as you will find in the exam information Canvas module, you are going to find the topics list that's going to be on exam 2. And I'll just have a little commentary on this list. But I just want to say a few things first before we go through the detailed information. I need everyone to understand that this exam is going to include information that you learned in chapters 5 through 8. Now, chapters 5 through 8, if we really want to go back and think about it, chapter 5 was the Capital Projects Fund. Chapter 6 was the Debt Service Fund. Now, those two chapters are governmental funds. Remember, governmental funds use modified accrual accounting. And just as an overall statement, I will say that the Capital Projects Fund and the Debt Service Fund are where you are going to find the vast majority of differences between modified accrual, which is used by the governmental funds, and accrual, which is used by the government-wide statements. So effectively, almost every journal entry that you touch in chapter 5 and 6, you are bound to see a difference between the modified accrual for the fund, the governmental fund, and the accrual on the government-wide. After chapter 5 and 6, we have chapter 7. Chapter 7 is, well, when we dealt with the second of the three categories of funds called proprietary funds. Now, the good thing is the proprietary funds use accrual accounting just like the government-wide statements. However, as you learned in this chapter, there's a lot of different vocabulary, especially when you're dealing with an enterprise fund like a water utility fund. The equity is a little bit different, called net position. So, of course, there are some differences that you'd have to learn there. And then last but not least, chapter 8. And chapter 8 dealt with the third of the three fund categories called the fiduciary funds. And the fiduciary funds do use accrual accounting, although they certainly are unique because the fiduciary funds are prepared, the financial statements are prepared at the fund level, but they do not consolidate up to the government-wide. So this test, out of all three exams, this is the one where, and this is the only one where you are going to see all three categories of funds. You are going to see governmental funds, you are going to see proprietary funds, and you are going to see fiduciary funds. That is a lot of information. So, pointers. When you are reading the question, you need to understand which fund or which financial statement am I asking you about. Example, if I ask you, let's just take number 1 as an example on this list. What does number 1 say? Proper recording of capital assets in governmental funds, proprietary funds, and government-wide statements. Well, if I give you a question and I ask you, how do you record this particular capital asset in a governmental fund? You need to understand, oh, okay, he's asking about a governmental fund. They use modified accrual accounting, so they don't record capital assets. So the answer, no matter how many numbers and how fancy I am in the question, if it's asking you about a capital asset and how much it would be recorded at in a governmental fund, your answer is 0. No ifs, ands, or buts. Be very, very mindful. But I can ask the same exact question, but instead of with the same numbers and everything, the same exact scenarios, and all I did was change one word. Instead of saying, how would you record the capital asset in a capital projects fund, where the answer would be 0, because a capital projects fund is a governmental fund, what if I said, how would the asset be recorded in an enterprise fund? Now the answer is different, isn't it? Because an enterprise fund is a proprietary fund, and proprietary funds use accrual accounting. And then, of course, I can ask the question and ask you, well, what is recorded at the government-wide level? Okay, so keep in mind, once again, I know I'm going back to basics, but governmental funds use modified accrual. With modified accrual, we are concentrating on current assets and current liabilities on the balance sheet. So whenever you're asked, how do you record this piece of equipment, or how do you record that long-term bond payable? The answer is always going to be zero, right? They're not recorded in the governmental fund balance sheet. Take a look at number 2. Number 2 is pretty much the same question as number 1. It's just twisted a little bit. The only difference is, instead of asking for capital assets, how do you record depreciation? Well, once again, if you're in a governmental fund, the asset isn't recorded there. Therefore, there is no depreciation. There's nothing to depreciate. I've said this in class before, but I just want to make sure you are zoning in on what is the professor asking. What is the professor asking? What fund am I in? Make sure you know what fund you're in, or if you're at the government-wide level, so you can put in your mind, am I dealing with modified accrual or am I dealing with accrual? That is so important. Number 3, recording of donated assets. So if you have an asset that is donated to the government, and sometimes that does happen, and if there is a donation of an asset, if the question is asking you about, once again, how is it recorded in the governmental fund, the answer is going to be 0, right? Because the governmental fund does not record any fixed assets. But if the donated fixed asset, if the question is asking you for how is it recorded in an enterprise fund or a government-wide statement, the answer is it's recorded at acquisition value, at the date of donation. Basically, you do an appraisal. And whatever that appraised value is, it's called the acquisition value. That's how it's recorded. It doesn't matter if I write in the question the person donating the asset originally purchased the asset for $30,000, but on the date of donation, the acquisition value or the appraisal, let's say, is $130,000. Well, that's what it's going to be recorded at, $130,000. So be mindful of that. Number 4, the sale journal entry of capital assets. So if I'm asking you, an asset was sold, asset that originally cost $10,000, we depreciated it for a total of 8. So that means the net book value was 2. And let's say we sold it for $5,000. Well, if we were recording that in the government-wide statements, you would record a gain on the sale of $3,000. No different how you learned it in your principles class. Okay? You would get the asset off the books with a credit. You get the accumulated depreciation off the book with a debit. You would debit the cash if you received a cash payment, and debit or credit, gain or loss. That would be true also for the proprietary or the fiduciary funds. But if the question is asking you, how do you record the sale for the capital assets in the governmental fund, be very wary. Remember, governmental funds use modified accrual accounting. Now, if I got a check in my hand for $5,000 for the sale of the asset, you would debit cash, obviously, and the credit would go to other financing sources. Remember, there's no asset recorded there. There's no depreciation recorded there. There's nothing to take off the books. We're simply going to credit other financing sources. Take a look at number 5, accounting for leases. All right, so remember, if you have a lease, we have to be mindful of, how that is recorded. In the general fund, remember, the asset isn't recorded there, but if it's dealing with a proprietary or government-wide statements, remember the general capital asset recorded at the inception of the lease. That is where you would record the actual asset and the liability for basically the present value of the future lease payments. If it's in the governmental fund, it would be an expenditure, just like you learned when you purchased a fixed asset. You record an expenditure upon purchase. So you can see all of these questions depend on what fund you are in. The answer can be totally different. Okay, now the next one, number 6, accounting for bonds. So now you can see before we go any further, 1 through 5 on this list is pretty much the chapter 5, the Capital Projects Fund. Now with it goes down to, I guess, all the way to number 7. And then we'll get into chapter 6. So number 6, accounting for bonds in the fund and in the government-wide statements. Now, typically, which fund are you going to account for bonds in? That would most likely be the Capital Projects Fund, because the Capital Projects Fund is the fund where we are going to use when we are constructing a major general government asset. Okay, so we're building a new park or we're building a new city hall, something major, right? As I usually joke in class, I'm not talking about putting up a shelf in the mayor's office. I'm talking about something major, like building a new police station, something like that. So typically when there's a large capital project like that, bonds are issued to get the seed money to go ahead with the project. When that money comes in from the bond, let's say we issued bonds for $10 million. Well, what we're going to do is in the Capital Projects Fund, you're going to debit cash and you are going to credit other financing sources. Okay? If you record it as a premium, the premium is typically recorded in the debt service fund. The reason for that is because the Capital Projects Fund only needs the principal value of the bond. Any extra money that comes in, like a premium, that would go to the debt service fund. If you sold the bond in between interest payment dates, if you remember from your theory class, probably theory 2 class, hopefully your professor taught you that you are actually going to collect extra interest from the bondholder. I know it sounds counterintuitive, but you actually collect interest from the bondholder. You know, the interest from the last interest payment date to the date of the sale of the bond. And then that extra interest is paid back to them in the first interest payment. So extra interest collected from the bondholder, it would be recorded as revenue in the debt service fund. However, if the question and the test is asking you for government-wide, you are going to use accrual accounting. And remember, with accrual accounting, the principal of the bond is a payable, the premium is also a liability, the discount would be a contra liability. You guys remember this, I hope, from theory class. And if you sold in between interest payment dates and you got to collect extra interest from the bondholder, you would record interest payable. That's for the government-wide. Number 7, recognizing the difference between a general capital asset. So that's a capital asset purchased for basically general government use. Something for the police department or for City Hall or something like that, versus a capital asset held by a proprietary or a fiduciary fund. Big difference is how it's recorded, of course. Now, they're all recorded as fixed assets at the government-wide level, but at the fund level, it's different. A general capital asset that's purchased or constructed is recorded as an expenditure, but a capital asset, because of modified accrual accounting. But if the capital asset is held by a proprietary or a fiduciary activity, it's actually recorded as a fixed asset, just like it would at the government-wide level. So be very, very mindful. It's so important. I keep beating you up over the head over this, but this is so important. Make sure you understand which fund or am I at the government-wide level. Make sure you know where you are at the question. Okay, now we go on to pretty much everything that would be in Chapter 6, which is the debt service fund, starting with number 8. Paying down principal and interest in a debt service fund and the government-wide. Well, in the debt service fund, both the principal and interest payments are expenditures. Remember, the debt service fund is a governmental fund. Governmental funds use modified accrual accounting. And when modified accrual accounting is used, we don't have long-term liabilities sitting on the balance sheet. So when I pay down principal, you actually have to debit an expenditure, just like you do with interest. However, if it's government-wide, you're going to use accrual accounting. And with accrual accounting, just like you learned in theory class, you will debit the long-term liability for the principal payment. You will debit expense for the interest payment. Number 9, the timing of expenditure recognition in the debt service fund versus the government-wide statement. So it's basically asking you, when do you record an expenditure using modified accrual versus when do you record an expense using accrual? Okay, first, the expenditure in modified accrual. Expenditures are recorded when they are due. So, as an example, if my interest payment is due in January and my fiscal year ends in December, your expenditure as of December 31st is 0. Remember, the expenditure is not due until January. So for the December financials, you're going to record 0. It's recorded when due. Now let's compare that to when we record the expense in the government-wide. As you learned in principles class and was reinforced in theory class, expenses are recorded when they are incurred, not when they're due, when they're incurred. Because of that, with expenses, you will need to accrue for the financial statements. Let me give you an easy example. We'll do the same example. Let's say 6 months worth of interest is due in January, the end of January. But we are preparing financial statements as of the end of December. Well, out of the 6 months worth of interest, how much was actually accrued as of December 31st? And the answer would be 5 months out of 6. So we would have to accrue 5 months worth of interest for the expense for the December financial statements. That's something you learned in principles class, and it's not going away. So make sure you understand, with expenditures in modified accrual, they're recorded when due. Expenses for accrual are recorded as they are incurred. All right, and we have to accrue for the financials. Number 10, I threw number 10 in here. I know number 10 was tested on exam 1, but the fact of the matter is we are in exam 2 and we're still dealing with governmental funds. So I still need you to remember that with governmental funds, equity is called fund balance. And remember, the equity, the fund balance, is broken down into 5 subcategories. Please make sure you don't lose the awareness and the knowledge in this area. Restricted, committed, assigned, unassigned, and non-spendable. Number 11, accounting for transfers between governmental and proprietary funds. Remember, when you have a transfer in with a governmental fund, that's an other financing source. When you have a transfer out, that would be an other financing use. Similar for proprietary funds, we just don't use that terminology. With proprietary funds, we typically just call them transfers in and transfers out. But it's very much the same concept of other financing sources and uses, meaning they're recorded on the operating statement. They're not assets and liabilities. They're actually on the operating statement, and they will affect equity either up or down, similar to revenues and expenditures. Number 12, when we go through a debt refunding, and remember what a refunding is. A refunding is just a fancy word for refinancing. So if we want to refinance our debt, this is how it works. The accounting is different. When we pay off the old debt, say we're refinancing our loan and we're entering into a new loan to refinance the old loan. Okay, and when we pay off the old loan, the principal, we will debit other financing uses up to, so there's a ceiling, up to the amount of new debt that was received. And if we are getting rid of some old debt without new debt money, and basically some money that was that we had on the side, you debit expenditures for the rest. Let me give you an example. So let's say our old debt is $5 million. Okay, and our new debt is $4 million. So I get the $4 million from the new debt, and I'm going to use that $4 million to pay off the old debt. So you will debit other financing uses for the $4 million. But then you take another $1 million from a cash account you had to pay off the rest of the old debt. So you would debit expenditures for $1 million. So debit other financing uses for 4, debit expenditures for 1, and then of course you credit cash for $5 million. This is unique because remember what you learned in chapter 6 especially, whenever you're paying down principal of a debt, you debit the expenditure. So here I'm introducing something else. You don't always debit expenditure when you're paying down principal. Depends on what we're doing. If we're just paying a regular debt payment, yeah, that's true. But if you're actually going through a debt refunding, you have to keep that in mind. Number 13, timing of the recognition of principal and interest expenditures in a debt service fund. That goes pretty much hand in hand with number 9 on this list. Interest and principal expenditures are recorded when they're due. All right, now we move on to chapter 7. So starting with number 14, we're in chapter 7. Capital asset accounting and proprietary funds. Just like good old accrual accounting. Just like you learned in principles class and were reinforced in theory class. Capital asset is recorded at historical cost. It's depreciated over its useful life. So we will have depreciation expense and accumulated depreciation throughout the useful life. Be mindful of that. That is completely different than governmental funds where we record capital expenditures when we purchase or construct the asset. Number 15, equity for basically everything. Basically, equity is called fund balance for the governmental funds and everywhere else. So that means proprietary funds, fiduciary funds, and the government-wide. Basically everywhere else where accrual accounting is used, equity is called net position. So the 5 categories of fund balance for the governmental funds, and 3 categories of net position everywhere else. Net position categories are, number 1, unrestricted, number 2, restricted, and number 3, net investment in capital assets. Make sure you understand what these 3 net position categories are and how to calculate them. First, net investment in capital assets. Let me give you a little formula to remember that. The formula at the end of the period, when I'm trying to calculate my equity category, my net position called net investment in capital assets, it is fixed assets minus accumulated depreciation minus any outstanding debt you have that was used to buy or construct the fixed assets. Let me give you an example. So here we are at the end of the year. We are preparing financial statements for an enterprise fund, which is in the proprietary fund category. And I look at the balance sheet. I have $10 million of fixed assets. I have $3 million in accumulated depreciation. And I've got $5 million in a loan payable that I know I used to buy the fixed asset. So if I had $10 million in fixed assets minus the $2 million in accumulated depreciation, that gives you 8, minus the $5 million in loan, that gives you $3 million. So your net investment in capital asset will be $3 million. Make sure you understand what would increase or decrease that. So if I asked you a question on the exam, what would additional depreciation do to your net investment in capital asset? Well, your answer would be it would decrease it, right? Because as I depreciate the fixed asset, my accumulated depreciation increases, which would decrease your net investment in that asset. So make sure you're understanding how that works. Restricted net position is very similar to restricted fund balance. Basically, anything that a law or a third party is restricting, how we can spend those funds. And last but not least is unrestricted. So whenever we need to increase or decrease your net investment in capital assets and your restricted, the opposite is happening to unrestricted. And how does it work in real life? Well, first net income is closed out to unrestricted net position, and then you update the other two categories. Number 16, payment of debt in an enterprise fund. So if we are paying down principal and interest of debt that's in an enterprise fund, remember, you're going to use accrual accounting. So you will debit the liability when you're paying principal, and you will debit expense when you're paying the interest. Be very mindful. Make sure, because I guarantee if you get a question, how do you pay down debt, principal in an enterprise fund? I guarantee the correct answer for the modified accrual is going to be one of your choices as well. Remember, with modified accrual, with the governmental funds, you record expenditures when you're paying down principal. But if you're in an enterprise fund, you're gonna actually pay down with a debit to the liability. Accrual is used. Accrual. Number 17, proprietary funds are the only place in this entire course where you're going to find a cash flow statement. All right, couple of things that you need to understand. And I'm not going to ask you to calculate a cash flow statement. So don't get too crazy with trying to study, oh, how does this cash flow statement work? Now, I will basically make sure you understand that direct method must be used, and the cash flow statement, instead of having 3 categories like you learned in theory class, which was operating, investing, and financing, on this cash flow statement, you're going to have 4 categories, which is operating, investing, but you're going to have capital financing and non-capital financing. The big difference is this. Anything dealing with buying and selling fixed assets, they get their own category called capital financing. If you recall from your other accounting classes, your for-profit accounting classes in theory class, you basically flowed all the fixed asset transactions through the investing section. So just be mindful of that. You might get a question or so on, if I give you a scenario and I ask you which of the 4 categories does this belong in the cash flow statement. A, operating, B, investing, C, capital financing, D, non-capital financing. That question is fair game, but of course I'm not going to ask you to calculate and construct a cash flow statement. That's not going to happen for this exam. Number 18, interfund transactions. This is very, very important. With funds, there's basically 3 types of transactions that can occur between funds. Number 1, that's when one fund is transferring money to another fund. Remember in class, I like to call a transfer a one-way ticket, right? It's money being sent from one fund to another with no expectations of payback. So remember, transfers in or sources, transfers out or other financing uses. That's number 1. Number 2, what can funds also do? They can loan money back and forth. So the fund that's doing the loaning out, they're going to record a receivable, and the fund that's receiving the loan, they're going to record a payable. And the last thing that can happen between funds is there's actually a service provided from one fund to another. The fund that's doing the servicing, they're going to record a revenue. And the fund that's actually receiving the service, they're going to record an expense or an expenditure, depending on what type of fund it is, governmental or proprietary. Okay, that pretty much through 18, that takes us through chapter 7. And so from 19 down on your list, we are talking about chapter 8. Chapter 8 is where we talked about fiduciary funds. Remember, there are 2 types of fiduciary funds. We have custodial funds and we have trust funds. Remember, the big difference is the custodial fund is more of a pass-through. It's where the government really doesn't have a long-term timeline to it. That's actually, providing a function. So as an example, the best example of a custodial fund is when you have a county tax collector. So the county is collecting taxes not only for themselves, the county, but all the other municipalities within the boundaries of the county. So if you listen to my lectures, as an example, let's just take Palm Beach County as an example. Palm Beach County is going to collect all the taxes, but they're collecting their taxes, the county taxes, and they're also collecting the taxes for the city of Boca and Delray and Boynton Beach and West Palm and Jupiter and Palm Beach Gardens and the Palm Beach County School District. So they're collecting basically all the taxes for all the taxing districts, if you will, the municipalities, the school districts, etc. All right. So the custodial fund is not going to record revenue or expenses. They're basically just a pass-through. They're going to collect all the taxes, all right, and they will then keep their piece, or I should say their piece will be transferred to the county general fund, and then they will, of course, write checks to all the other taxing districts, right? So Palm Beach County will collect taxes for Boca Raton, and they will write a check to the city of Boca Raton. Remember, totally different governmental entity, all right? It's a pass-through, cash in and cash out, as you heard me say in the lectures. Cash in, cash out, all right? There is no equity, all right? All you're going to see on a balance sheet of a custodial fund is cash, current receivables, and current liabilities. That is it. Versus a trust fund is where there is a long-term relationship. So a custodial fund is a quickie. It's a pass-through. A trust fund is a long-term relationship. That brings us to number 20. There are 3 different types of trust funds that we talked about in this chapter, chapter 8. We have investment trust funds, we have private purpose trust funds, and we have pension trust funds. So an investment trust fund is where a bunch of governments get together and they create an investment pool. All right. So all the investments are assets in the trust fund. And the share of the ownership share of the assets is on the opposite side of the balance sheet. Internal participants, basically those are those governments that are the same as the governments that is actually managing the big trust fund. Their ownership piece is going to be recorded as a liability, but all the external governments, the external participants, their ownership share of the trust fund is going to be recorded as a net position. So let me give you an example. Let's say the city of Boca, Deerfield Beach, Delray Beach, Boynton Beach, Palm Beach Gardens, Coral Springs, FAU. FAU is a good example. They're a governmental entity. Let's say they all get together and they decide, you know what? Let's pool all of our money. We'll have some efficiencies if we invest together, save some costs, and let's go for it. Well, out of that group that I just mentioned, one of those entities needs to volunteer and say, okay, we will account for the investment. That, let's say in my example, the city of Boca Raton, they're the ones that say, okay, we will actually account for the investment trust fund. That means they are the internal participant, and everybody else that I just mentioned are external participants. So the city of Boca's share of the ownership share of the investment fund is going to be recorded as a liability, and the external participants' share is going to be recorded as an equity or net position. All right. That is actually I know I jumped down, but that's actually number 26 on your list. All right. Getting back to number 20 for a minute. The second type of trust fund is called a private purpose trust fund. That is when the government partners with a private entity or a private individual to run or to manage a program. That's not a typical government program, but something that the government would like to be involved with. Okay? That is something where a private purpose trust fund would be used. And last, a pension trust fund. A pension is basically money set aside. I think most of you know what a pension is. It's money that is set aside for eventual retirement income for once the government employees retire and they become retirees. All 3 of these trust funds, investment, private purpose, and pension, they can have income and expenses, but we don't call them revenue and expenses. We call them additions and deductions. So make sure you're aware of the vocabulary. Okay, the interesting thing about all fiduciary funds, that would be custodial and trust, the management of assets that don't belong to the government. They are basically management of assets that don't belong to the government. Therefore, we will report them in a financial statement at the fiduciary fund level, but they do not get reported at the government-wide, remember, which is like a consolidated financial statement for the government. That's number 21. Okay, number 22. This is dealing specifically with a pension trust fund, and it's the calculation of the net pension liability. Current GASB states that every government needs to carry a net pension liability, or quite honestly, it could be a net pension asset on the government-wide financial statements. And the net pension liability is the difference, I have it here in brackets, it's the difference between the total pension liability and the net position in the pension trust fund. So the total pension liability, that is usually a number that's prepared with the help of an actuary. An actuary takes all the demographic information of the employees and the retirees, and basically what the total pension liability is, if we, the government, needed to pay out all of the pension liabilities for the rest of everyone's lives, the employees and the retirees, how much would that number be? So it's like the doomsday number. If we ended today and we needed to just pay out everybody what they're expected to receive for the rest of their lives and their beneficiaries' lives, all right, this is what the number is. Boom. You take that number, you compare it to the net position, which is the equity in the pension trust fund. Whatever the difference is, if the total pension liability is greater than the net position in the trust fund, you have a net pension liability. And in the case where the total pension liability is less, all right, I think that would be kind of rare, but it could happen. If the total pension liability is actually less than the net position in the trust fund, you have a net pension asset. Number 23, this is dealing with the investment trust fund. I need you to be very well aware, and you can go back to your homework. We definitely have a homework problem on this, and we had a problem in the Chapter 8 PowerPoint on this. What journal entries you use to create the investment trust fund, and getting the assets basically transferred over from the individual governments to the investment pool. All right, and then the subsequent operation, right? Those investments, they earn interest and dividends. They increase and decrease in value. How is that recorded? How is it allocated to the participants in the investment pool, both the internal and external participants? All right. Number 24, I don't know why I threw this in here, but it's something that you need to be cognizant of. Remember, this is so important. When you are reading these questions, make sure you know where you're at. Make sure you clearly understand that modified accrual is used for governmental funds, and accrual is used everywhere else. That would be proprietary funds and fiduciary funds and government-wide. And number 25, which is really last because we already went over 26. Number 25, your accounting entries in a custodial fund. Remember, the custodial fund pretty much is going to have, they're just a pass-through. They are collecting money on behalf of other governments. So cash in, cash out. And once again, we had examples of the accounting entries in homework problems, as well as the PowerPoint presentation for Chapter 8. All right, so make sure as you're studying for this test, you are aware of these 26 items, and you did your homework. You listened to my lectures as well as listen to my homework explanation videos, and of course, you got to practice your homework yourself. All right, it's more than just listening to me. I'm giving you a lot of tools, but you need to practice yourself. All right. So this test, once again, very important, chapters 5 through 8. You're going to get the kitchen thrown at you. You've got modified accrual with the governmental funds. You've got accrual with both proprietary and fiduciary funds. You always have to keep in mind the government-wide statements. Make sure when you read these questions you know exactly what I'm asking. You know exactly what fund you're in, or if you're at the government-wide level. And sometimes you don't need exactly everything in the paragraph that I'm going to give you in order to answer the question. So don't be intimidated if I give you a long paragraph, but you only need maybe 1 or 2 sentences out of a 5-sentence paragraph to answer the question. Okay? So you just need to kind of understand what's important and what's not important for each individual situation. You have a 2-hour time limit on this exam. So you can certainly go through your exam. If you go through the exam and you still have a lot of time left, go back and check yourself. It really bothers me sometimes as a professor when I see on the exam a student only takes 30 minutes, and I say to myself, my goodness, there's another hour and a half that you could use to check yourself. Now, I don't want you to check yourself 4 and 5 times. That's going to get a little bit ridiculous. But certainly go back and recheck yourself. You'd be amazed how many times you see, oh my goodness, I missed that one word or that one phrase. That completely changes the meaning of the question and the answer. All right, so be very cognizant of that. And I wish you all the best. And of course, if you have any questions on the material, please contact me. It would be my pleasure to get back to you to make sure that you understand the material. That is the most important thing for me, is that you are understanding governmental accounting.